Oh, Anthony and Tara, I see that you have reached out to me and I have a couple more questions regarding your estate planning and the goals related to that. So, we're going to go through that today. So, to begin, we're going to talk about the charitable trust and the donation of the animal center. So, you guys have come to me and you've decided to establish a trust, a charitable trust, and donate the animal center to the trust. So, your goal overall is to receive an annual income from the trust during your life, with the trust assets passing to charity when you guys unfortunately pass. So, because you guys both expect to live a long time, you want the income from the trust to provide you with the potential hedge against inflation. So, overall, you've come to ask me which charitable trust will be best to meet your objectives and why. So, in order to do this, we have to compare the different features of the variable charitable trusts in order to further explain the total tax benefits that arise from the transaction and which trust would be best for you in this scenario. So, to begin, we're going to go through all the charitable trusts. So, first is a PIF, where you cannot touch the principal, and there's a variable payout that's limited to the assets that you can contribute. Next, there's the CRAT, which is fixed payments, and you must use the principal to pay out, but unfortunately, it does not keep up with inflation, so that really isn't an option for you guys. There's also the CLAT, which is a fixed payment also. Now, it goes to a non-charity benefactor, which is not what you guys want. And also, to pay out, the principal must be taken out, and it doesn't keep up with inflation, which is also another problem. So we're also going to rule that one out. Last, we have the CRUT. You can use this principal in a tough year to get you guys past. The payout is also variable and based on a percentage of the assets, and it also has the ability to keep up with inflation. So, in my opinion, guys, the CRUT would be the best option for you guys in this scenario. So now we're going to talk about the tax treatment of some gifts. So Anthony, you made the following gifts this year. You gave $60,000 to Tara, you gave $40,000 to each of your three children, and you also gifted $50,000 to the American Cancer Society. So we're going to go through the tax treatment of all these gifts. So for the gift to Tara of $60,000, she's going to have the $15,000 annual exclusion, which leaves her with $45,000 remaining. Now, there's going to be a $45,000 marital exclusion since you guys are married. So that leaves you with no or zero for your tax treatment on this gift. So now we're going to go to the three children. Now there's $40,000 each. There's going to be $15,000 annual exclusion for each of those $40,000 gifts. So that leaves us with $25,000 for each child. Times that by three children, and you end up with $75,000 in total. Lastly, the American Cancer Society, with your gift of $50,000, you're going to get the $15,000 annual exclusion, which leaves you with $35,000. Now we're going to take that $35,000, and it's going to be a part of the charitable exclusions, which leaves you with $0 also. So, in summary, the total taxable gifts you have in this scenario are equal to $75,000. Next, we're going to talk about splitting gifts. So, if Tara agrees to split the aforementioned gifts with Anthony, what would the taxable gifts be for the year? Well, for the first gift, the gift to Tara would be unaffected since you can't split a gift to yourself. Next, the gift for the three children, where we're doing $40,000 each. They'd be allowed $30,000 annual exclusion for each, which leaves you $10,000, times three children would be $30,000 total. Now with the American Cancer Society gift of $50,000, you get a $30,000 annual exclusion, which leaves you with $20,000, and a $20,000 charitable exclusion, which leaves you with zero. Now, in summary again, there would be a total taxable gift equal to $30,000. Also, Anthony would need to file a gift tax return, and we would also need Tara's signature on that document. Next, we're going to talk about the payment of medical costs. So in 2021, Marlene has incurred substantial medical bills at the local hospital, and Tara, you decide to pay $100,000 directly to the hospital in payment of Marlene's medical expenses. So, the question you've come to ask me is, what is the amount of the taxable gift as a result of this transaction? So actually, in this case, gift tax does not actually apply. The requirements for this include that the gift was paid directly to the hospital and the payment was made directly and exclusively to the healthcare provider. So since there has been a direct payment of Marlene's medical bills, they are gift tax exempt, and there would not be a taxable gift as a result of this transaction. Now we're going to talk about the gift to Eric. So if Anthony were to gift $100,000 to his nephew Eric, a vet at the care center, and wishes to pay tax on the gift, how much will he owe? So we start with the $100,000 gift, and it's applicable for the $15,000 standard gift exemption, which leaves you with an $85,000 taxable amount. So to calculate the amount of tax, we'll use the following chart. So we will go down, and the number is between 80 and 100,000 since we have $85,000 of taxable income. So we'll take 18,200, and then we will use the rate on the axis over of 28%. So to calculate the total amount of tax, this will be how we will do it. So to determine Anthony's gift tax amount, it will be as follows. So you'll take the 18,200 that we mentioned before, plus 28% times the $85,000 minus the $80,000, which is $5,000, which gives us a total of $19,600. I also feel that it's important to note that the out-of-pocket costs could be avoided by using an applicable exclusion amount. Although the downfall of this would be that it would decrease the tax credit for the estate when that time comes. Next, we're going to talk about the Children's Trust and the associated crummy powers. So, an overview here is that the Benson's Children Insurance Trust, the beneficiary are all 4 children. The life insurance policy has been transferred on June 30th of 2020, and there are crummy provisions on this. So let's go over what crummy powers are. Crummy powers were developed in order to take advantage of the annual gift tax exemption. You generally have 30 days to withdraw, but since we want the money to pay the premium on life insurance, we don't want a withdrawal. It will effectively move the life insurance policy out of the estate. This method of gifting will also remove the tax consequences on paying the premium for the children. And lastly, we are also able to make future interest become a gift today, which is great. So overall, guys, I'd like to thank you again for your time and reaching out to me for anything that you need. As you should know by now, I'm always available, and if you ever have any more questions, just please feel free to reach out to me. If that's everything, guys, I'd like to wish you guys a great day, and thank you again for coming.